Welcome in. Anthony Levrets here, host of the Next Pitch podcast, and I am joined for another episode of our Homefront, our conversation about how to help veterans and all homeowners through the home buying process, but with a focus on veterans and how do we make that experience better for them. Joined by Jared Paul, part of the veteran engagement team at CrossCountry Mortgage. Jared, thanks for doing this, man.
I appreciate it, Anthony. Thanks for taking the time today, and looking forward to just getting some more information out to veterans to help them make decisions. At the end of the day, it's an information piece, the Homefront is, and that's what I love about it is there's nothing here other than a resource for veterans to be able to rely on to gain information about the process. And even if they use it and they're going with any mortgage company, as long as the veteran's being taken care of, I'm super happy about that.
That's what I love about you. And we're going to talk about a super sexy topic today, the word credit, which is what everybody walks around thinking about. But before we do, every single episode we talk about Till Valhalla. You wear a Till Valhalla shirt. You got one on today. What are you wearing today? What does it say? And what's the mission behind what they're trying to do? I absolutely love it.
It's one of my favorite things. And actually, one of the things that we've started doing is we're sending veterans, when we close a transaction for them, a t-shirt from Till Valhalla. We ask them their shirt size and send it over, because a portion of the proceeds from every shirt that's sold goes to prevent veteran suicide. And that is an unbelievably necessary and needed resource for veterans. Veterans obviously come back from combat zones, and even some that don't go to combat zones have PTSD and issues that come up, and being able to give them a reason to stay living and see the purpose in this life and the impact that they can have positively on others is Till Valhalla's purpose. And I love that. My shirt says, real heroes don't wear capes. They wear combat boots and dog tags. So it's just a way of referencing veterans, and that, especially in the time that we're in today, people are on the front lines throughout the world, right? In all kinds of different environments. And I think you and I talked about this, but I change my voicemail every day. And with that, at the end, I always say, especially during times of conflict, that we're praying for our veterans, and, we really want them to come home safe. And we're also praying for their families here at home. So hoping that with everything that's going on, we can get everybody home safe and, continue to have people serve us, but have their families know that they're safe as well.
Yeah, I think it's an important message. And you don't always, in our country wasn't planning on going this direction today, but in a country that seems to be pretty divided, you don't have to always agree with every war that happens, right? Like that's not part of what you have to do, but having admiration and respect and gratitude for people who wake up every day knowing they may need to run towards a bullet is something that I have deep admiration for. People like that, whether it's veterans or police officers or firefighters or anyone that's in that frontline response of serve, protect the people that live in this country. I've always thought that I would be one of those people that in those environments would do that, but I've never had to do it. All I did was was put a ball through a basket and then teach people how to put a ball through a basket for most of my life. But the idea that people wake up every day with that realm and that thought process is amazing to me.
Well, and remember, they volunteered to do that, right? There aren't very many people, if any, that are still in service that aren't volunteers that chose to make that decision. And we also need to remember, during the Vietnam War and some of these other conflicts, people came back, and being veterans, they were looked down upon, or people protested against them. And my comment to that would be, just remember that veterans don't have a choice. When we sign up, right, we're following orders, and we sign a contract that says we will follow lawful orders and do that. And they don't have a choice. They're doing their job, and they deserve our admiration and respect, even though we may not all agree on the reasoning behind every conflict and every war. Understand that they're doing that as a volunteer, and they're doing it because they were directed to, and it's to be for the benefit of all Americans.
Good point. All right. Let's transition. I don't know how you transition from that conversation into what we're going to talk about next, but credit, Jared. We're going to talk about credit today, baby. So the number one, what is credit? Let's not talk about the loan process now. Let's not talk about mortgage yet. We're going to dive into that. But
Right.
just in general, what is the term credit and what does it mean?
Well, let's make sure that we're referring to credit, which is a credit score that comes from TransUnion, Equifax, and Experian, and not a credit on your loan. There's two different things there.
Good job.
One's good and one is necessary, but necessarily not the favorite thing of everybody. But really, credit is a snapshot of your ability to repay, right? Or your history of repayment. So when you go into a credit report, the three bureaus that are out there are collecting data so that people that are lending money have the ability to look at your history of using credit, paying credit, whether you're a good credit user or a poor credit user, and make a decision on whether or not they should lend to you. And on top of that, make a decision on what risk level you are if they're lending to you, which can impact your interest rates. So having good credit is very important. And in my past, Dave Ramsey is somebody that teaches debt-free living, and I love the debt-free living piece of it. My problem with that is people that don't use credit are often treated as if they have bad credit. And so I'm a little bit more on the, hey, if you don't like credit, that's fine, but use it a couple of times a year just to maintain a credit score so that you don't get treated like you have bad credit.
I was that guy. So when I bought my first house, we won't talk about the reasons why on this show of why I got to this point by 34, 35 years old, that I didn't have any credit. I had never established, I did not show up in the world of credit when I went to buy my first house. And when I bought, we were able to use at that time still my wife's credit score and my income I don't believe you can do that anymore. Maybe there's an exception or two somewhere along the line that you can find a loan somewhere to do that. But in general, that's not allowed anymore. But that's how I bought my first house, because I had zero. I had never paid for anything that I couldn't write a check for or pay cash for.
See, and I was the opposite. I had never had credit. I joined the Marines and got stationed at El Toro, and I went down to the PX, the commissary, and I bought myself the biggest, baddest Kenwood stereo system I could to rock the barracks, right? And every weekend I was rocking it. But, supposedly there's a payment due when you do that stuff. And I didn't make any of those payments. And so when I got out of the Marines, I was a 520 credit score. I had no idea, right? It took me 3 to 5 years at that time to be able to repair my credit, not from actively repairing it, but just from making payments on time, and through time, it repairing itself. So I didn't have no credit. I had terrible freaking credit.
And we're going to get into that. But why is it important to consumers in general to have your credit score as high as you possibly can? And once we get through this, then we're going to get through, in what it looks like and how it impacts the loan process. But just in general, having a higher credit score does what for consumers?
Well, it does a lot of things. So what it really does, the primary thing, is it makes sure that you're not overpaying for things, right? So living on credit is something that almost everybody does at some point in time. But if you're somebody that hasn't taken care of your credit and you're not doing the little things to establish a good credit history and a long-term positive payment history, you're going to pay more money for objects when you do have to use a credit card, right? So on a credit card, if you're a 700 credit score or a 750 credit score, you might have a rate of 10.99, 12.99. Whereas if you're a 620 or a 580, you might have a credit score interest rate that is going to be substantially higher, like in the 20s. So if you put a $500 or $1,000 thing on a card and you pay for it for just a year, which isn't that long term of a debt, somebody that's paying 12% versus somebody that's paying 24% is paying a lot less money for that item. So having a good credit score is financially beneficial because it ensures that you're paying the least amount necessary while using credit if needed.
So basically, having good credit keeps more money in my pocket over the course of my life if I maintain my credit score. Having a worse credit score than would have a lower credit score would give more money out of my pocket over the course of my life. So the higher my score, when I buy things on credit, the less money that's going to cost me in interest.
Absolutely. And there's people that don't want to use credit and only want to maybe use it down the line to buy a home, something like that. So even if you don't think you're going to need credit, even in buying a home or buying a car or buying a table for your house, keeping more money in your pocket because you're not paying that higher interest rate means that you can direct that money to something else, to retirement, to paying off any other debts that you have, to college funds for your kids. So having good credit allows you to reallocate money that you would be spending for poor credit into other buckets in your life that'll help you build family financial wealth long term.
So to be clear, we're not credit repair experts, right? So if any of the information that you hear here, this is general information. If you have specific questions, you need to find somebody that is a professionally accredited credit repair person. We're just talking generally about what credit is and how it is used. How generally can I build credit? I'm new to the credit game, and I want to, maybe I've had one credit card along the way, and I only have one trade line, and my credit score is okay, but I want to build credit. What is a good way to build positive credit moving forward?
So I love this question, and I get this question a lot when I'm talking with folks. So the first stage of building credit is on us as parents. We should probably get our children when they're 16 or 18 years old an authorized user card on one of our credit cards so that they're establishing credit from 16 to 18 while they're still in our household, maybe even while they're in college, right? But a lot of parents will give them their own credit card, which doesn't help the child build credit. This is something that you need to start as early as possible. The second phase of it is if you're somebody who's out in the workforce or you're a college graduate, go out and you can get a secured credit card where you give them $200 and you prove to them that you're going to pay on time, and they will eventually flip that into a regular credit card. And then the third phase of life is when people get into their 30s and they're starting to look at home buying and those types of things, which tends to be kind of the median age when people go to buy. Then you're looking at having that credit that you've established, that your parents helped you with, that you did on your own, and that you now are able to use to buy what is a large ticket item in a home. But to build credit, the credit company is looking at a variety of things. They're looking at your length of credit. So the longer that you have credit, that's good, the better it will be in the future. You want to have a variety of credit. You don't want to have high consumer debt, right? You want to make sure that you might have a credit card and maybe a car loan and maybe a personal loan from a bank. That will help because you now have diversification in your credit. And the last thing that is very important is the recency of events. So this is one that comes up a lot on obviously the mortgage side, but if you have a late that occurred this month, your credit score is going to take a big hit because that's a recent event. Whereas if you have items that occurred 12 months, 24 months, and 36 months ago, the further that they get into the past, the less impact they will have on your credit. The reason I bring that up is a lot of people get discouraged. Oh, I had poor payment history in the past. Most everybody had some poor payment history in the past. It's what you've done in the most recent 12 months and what you're doing going forward that will change your credit score long term.
Okay, so just summarize here. Length of how long I've had my accounts.
Yep.
The variety of accounts. So what that looks, it's not just the same, just having credit cards. It's different types of credit, recent events. And then isn't also the amount owed versus my limit an important part of that bucket of how the bureaus look at your credit score?
Yes, it's your credit usage ratio. So if you have $10,000 of available credit and you've used all $10,000 of it, you're using 100% of your available credit. That will have a negative impact on your credit score. There are thresholds within each credit company's scoring system, but typically if you're at 66% of the available balance or 50% or 30%, the lower it goes, the better impact it has on your credit score. So somebody that has $10,000 available credit and is only using $1,000 of it is using 10% of their available credit. They're going to have a more positive credit or positive impact. That trade line will have a more positive impact on their credit score than the person that has 10,000 available and is using all 10 grand. The other piece is if you exceed the credit limit. right? So if you have a credit card that has a 10,000 limit, but with interest, it shows that you owe $10,001, you've now exceeded your credit limit, and that even has a worse impact on your credit score. Whether or not you're paying it on time, you're not going to show negative payments, but your credit usage ratio is very high, which means that'll have a negative or a more negative impact than somebody who is using less.
So building credit is length, have it for a long time, have credit for a long time. Variety, have a variety of types of credit. Make sure you make your payments on time. And amount owed versus limit. And so my assumption is the way to hurt it is to not have credit for very long, not have very many, not have a variety, don't make payments on time, and owe way more than your limit or owe up to your limit, and that's going to reduce your credit. Other big ticket events like getting my credit pulled for a mortgage, a boat, a car, a credit union, all within the in a
30 or 60 day window
in a short window. I think on the other end of it, the bureaus are going ding, 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 ding. That person's risky. They're trying to add a lot of credit and debt to their life. That's another way that you could hurt that as well, correct?
Absolutely. So it shows that you're actively shopping for credit. And again, in any space, car dealerships are the worst. They will shop you to 30 different places trying to find an interest rate that works for you. So when you go buy a car, make sure you let them know that you only want them to run your credit once. Seeing credit reports for the past 25 years, I've seen car dealerships that have run it 30 different times for people. Has a terrible impact on your credit score, even though it's for the same reason and it's done within the same time frame. That's a large number of credit pulls. So you want to make sure that you're not actively shopping for credit. And the other thing that happens is in any industry, people don't want you shopping. So they'll tell you not to have your credit pulled by somebody else. If you're having your credit pulled by 2 or 3 lenders because you're shopping within a 30-day window, it has a minimal, if any, impact and is honestly something that is expected. They don't expect people necessarily to always go with the first person they talk to. If you're shopping for a mortgage and 2 or 3 people talk to you, that might have a very minimal impact. It's something that salespeople, I hate that term, use to try and keep you. They'll scare you into not letting somebody else pull your credit because they're trying to make sure you don't talk to anybody else.
So you got to my next question here. Let's just frame this now. Now we're gonna dive into the mortgage component of this. Okay. Yep. So at some point in time, I'm gonna have my credit pulled if I want to have a loan close. If I want to buy a home, I'm gonna have to have my credit pulled. When do you believe as a loan officer, and maybe there's not one specific answer, maybe it's different, but when do you believe as a loan officer the right time to pull that credit is? And then 2-part question, what is the impact on my score? I remember as a loan officer all the time, especially young people would tell me, I don't want to have my credit pulled from my mortgage because it's going to hurt my rate because I may not be ready to buy for 6 months. And I don't want to know, I don't want my credit to go down because you're pulling my credit. Talk about kind of when should I pull it and what is the impact on my score in the mortgage process?
So first of all, sign up for an online thing. You can get 1 free credit report every year. If you're not working with somebody, monitor it yourself.
Who would you give a range of a few people that you can do that with?
You can go to Experian.com. Credit Karma's out there. You can usually get it through some of the banks, right?
Your bank should have at least, and it might only be one of the bureaus, but your bank will provide you at least one of the bureaus, and they're all going to be fairly close.
Absolutely. It at least gives you something to track, right? Yeah. There are different scoring models, and this gets into the weeds, so I'm not going to get into it out there that people use to score people's credit, but you can at least follow trends. Hey, I was a 700, I went up to a 708. That's a good thing. Hey, I was a 700 and I went down to a 660. What in the HE double hockey sticks happened, right? I got to be able to look at it and be able to follow that trend. So do some of your own homework. Don't just trust that somebody's going to give you the right info. As far as when it's the time to do it for a mortgage, if you are purchasing, you want to do this 60 days before you're ready to purchase. You don't want to wait. I get people that find the home and then they try and get approved and the home goes under contract before they're able to get approved because their timing was off. If you're thinking about buying a home, a lender can do one of two types of credit pulls, a soft pull or a hard pull. The soft pull is typically what we use to get an idea of what your score is to do an initial application. On some loans, like government loans, we do need a hard pull to be able to run the loan through the automated systems. But if you start 60 days early and there is a problem, you can address it. If you start 60 days early and there's no problem, that is good for up to 120 days. So we don't have to re-pull your credit for up to 120 days. And in today's world, everybody's about efficiency and time. Realtors don't want people touring their homes that aren't pre-qualified. They don't want to accept offers for somebody who's not pre-qualified. If you are proactive in your approach and you get your credit pulled 30 or 60 days before you're ready to look, the lender can provide you a pre-approval or a pre-qual, and they can provide that to the listing agent to show that you're serious and show that you've done your due diligence and you actually are qualified to be able to buy that home. So timing is a very, very important thing.
So we addressed this a bit earlier, but the impact on my score is going to be nothing or negligible if I get my credit pulled just for a mortgage. And even if I go to another lender and say, hey, I'm going to compare and shop, which is smart to do,
Yep.
go get a second opinion. Your credit is not going to be significantly impacted, if at all, by that type of credit pull. What would be is if you went and did that twice for a mortgage, and then at the same time had your credit pulled for a credit card and for a boat. Like that's
Yep.
going to show the bureaus that you're risky right now. We need to drop that score.
Yeah, and typically that's a 10 or 15 point drop when you're shopping multiple things. If you're shopping multiple things with multiple places and you're doing that with, a car, a credit card, a boat, and a mortgage all at the same time, I've seen it drop 30 points.
Yeah.
But I get this one too. Well, Jared, my credit score dropped 70 points because somebody pulled my credit. What I typically find in those circumstances is when I do have the chance to pull the credit, there was typically a medical collection that got reported that wasn't on when the last guy pulled their credit, or they missed a payment on a credit card and that impacted their credit. If you're seeing something move more than 20 or 30 points, it is usually something much more impactful, like a late or a collection or something like that has occurred on your credit. It's not the lender. So just be aware. I get that conversation a lot. Hey, the last time I had a lender pull my credit, I was a 700. You told me it was a 620. I can usually review it and say, hey, it shows that, it's April 5th. On April 1st, you had a late on your credit card, and that's what's impacting your credit score because you had a recent late, as we were talking about recency of events earlier.
Okay. So let's move on here. So now I've gotten my credit pulled, and I am a 640 and a 740, right? You got two different borrowers here. Same exact loan scenarios, right? The same amount, loan to value, same down payment, same program. And this is where, it's real money in everything that you do. But when you're talking about loans of this magnitude, of this size, the money matters. What would a 640 versus a 740 credit score in today's market average on a $500,000 loan? What would that monthly payment be difference between a high credit score versus a low credit score?
So it's going to vary depending on loan program, right? That's an important.
Let's put us all in the same program. We're all in a conventional loan right now. I've managed to qualify at the 640 for this conventional loan, and that's what is the difference in my rate on that?
I would say probably a half of a point on average in interest rate. So you probably go from 6.75 to 7.25 by having a credit score that is higher. So that half of a point on $500,000 is probably $200 to $300 a month difference in payment. Call it $3,000 to $3,600 a year. Over 30 years, that could be $90,000 to $100,000 difference in payment. The reason I bring up the programs is when you're dealing on VA and FHA, right? VA, FHA 640 and higher, you typically have very similar interest rates because they're government-sponsored programs. You don't see as much of a swing in the interest rates. On those programs, 620, 640 or lower is where you really start to see the difference in interest rates on those programs. But on the conventional side, it is a much bigger spread. They work in, and again, getting into the weeds, what they call a tranche of 20 basis or 20 credit score points. So somebody 640 to 659 gets one interest rate. Somebody 660 to 679 gets another credit score.
It's a great point. I'm glad you brought that up.
Yeah, it's their risk levels, right? And what they've created is what's called loan level pricing adjustments. And the loan level pricing adjustment gets higher, meaning it costs you more the worse that your credit is. It's because you're a riskier borrower. Your credit history shows that if you have a 620 credit score, that person is much more likely to have a credit late or a mortgage late or a payment late than somebody that has a 760 credit score that is shown that they pay their bills on time consistently.
So good stuff, man. So in summary, credit is what is my credit score is determined by how long I've had my credit, the variety of credit that I have, recent events, and amount owed versus my limit, right? There's some 100%. Other factors in there, but that's the majority of it.
That's the part that's important about the credit piece. There are other factors that we've talked about in previous and that we'll talk about in future episodes that will go over other details that impact it. But one last thing I want to touch on, a budget. If you have a budget, you will have a better credit score almost inevitably. Obviously, life events get in the way, but have a budget. Just look at the numbers. When I met Tiffany, my wife, who's also my partner in this business, I had gone through the mortgage meltdown and I had a spreadsheet, but my credit had taken a hit because our industry was in a bad spot. Since I met Tiffany, every month we look at a spreadsheet and go over what bills we have. And we have literally never missed a payment since that time, because even the times where it was like, I didn't see the credit card bill come through, looking at that list every month made me go, hey, I didn't see the Alaska Airlines card come through. I need to make sure I pay that. It's a way to give yourself a reminder to make payments on time. Even if you don't want to do a budget, write down a list of all of your monthly debts so you can check them off every month and make sure that you're making the payments and you don't miss one and end up paying more for things because you made a mistake one time, whereas having a checklist would have helped you avoid that mistake. Budgeting, checklist, have a checks and balances to make sure you're doing your part to take care of your credit.
Yeah, and one other thing to go along with that is with credit cards or anything that allows you to do it, doing auto pay on it to at least, so if you do forget, having the auto pay to pay the minimum each month, especially on your credit cards, will keep you from accidentally missing that $50 payment that can have a major impact on your life and cost you significantly more down the road.
100%. And if you don't have a budget or you don't have something like that, send me a message. I'll send you a copy that I share with our clients. We have this conversation with almost every client about budgeting. I'll send it to you. It doesn't cost anything. You can plug in your own information. It's an Excel spreadsheet, really easy to track.
Good stuff. All right, man. Well, we talked about Till Valhalla, and we always do at the beginning of every show. But you do a bunch of charity work in philanthropy with your business and give back for every loan that you do. And we want to highlight an organization every time. And today it's going to be Military Makeover. Tell us a little bit about that organization and why you like them so much.
So Military Makeover is an online television show, obviously run by a company that's a for-profit company. But when I was at Lend US, which was bought by CrossCountry Mortgage, that company helped me and many other people in the company support veterans by being part of Military Makeover. They actually rebuild or refurbish a home for veterans. So if it's a disabled veteran, you know, they'll go in and make the home handicap compliant. If you have, a home that you bought that's having roof issues, they'll go in and fix that type of stuff. But we've always taken on, as part of Military Makeover, a project. So we've done a backyard space for a veteran that has PTSD to relax in. We've done a skateboarding holder for one of the children that loved to skateboard and collected skateboards. You find a project within it. But Military Makeover is hosted by Montel Williams. It's on the Armed Services Network, and it's a fantastic show where 10 or 20 companies sponsor, and they send people down, and the people don't get paid. They're there just to honor the veteran and try and improve their living situation and their home situation by upgrading, refurbishing, or providing something with that home that benefits that veteran and improves their life. And Military Makeover is a show you should check out. It's really, really cool. It's fun to see what they do for veterans and to see the difference in the home from when it started to when it finishes. And all of the people that are affiliated with being a part of that is an amazing thing. And to see the appreciation of the veterans at the end is fantastic, to see the way that it changes their lives.
And that's what I love about this with you, Jared. It's about changing veterans' lives and helping. Obviously, you're a for-profit guy too, right? You're a businessman, but the importance of giving back and putting your money where your mouth is. You talk about wanting to help veterans, but you actually get involved in doing that. I love that, and I'm honored to get a chance to help give you the platform to do so, man. Appreciate you doing this today, and we'll till next time, man. Make it a great week.
You as well. And I'm honored to have the opportunity to serve veterans and give back to the community that changed my life. And I hope to continue doing it for 25 to 30 more years.
All right, Jared, take care. Talk to you soon.
Talk to you soon.